Good evening and welcome to the webinar. I have over 12 years of experience in the financial markets as a prop trader and as an educator, and my expertise lies in trading derivatives such as currencies, commodities, and stock indices. I'm licensed from FINRA in USA and from CMA in UAE as an investment manager. I have spent over 10 years mentoring traders on how to trade consistently, how to manage their risk effectively, and how to develop long-term trading strategies in the market. Welcome to Amana. We are a trusted broker with over 15 years of experience, and we deliver exceptional trading execution and client service. We are regulated by multiple regulations, both local and international. So locally, we have the DFSA and the CMA regulations, and internationally, we have SISEC in Europe, CMA in Lebanon, LFSA in Malaysia, and FSC in Mauritius. We have a strong focus on the MENA region, and we provide over 5,500 instruments across global and regional markets. That includes stocks, forex, commodities, indices, ETFs. We also have Amana Invest, which is a feature which offers you professionally managed portfolios designed to help you build long-term wealth without the need of active trading or management. Below your screen, you can see a Q&A section. If you have any questions during this webinar, please drop them in the Q&A section and I or my colleague will try and answer them. Do not write your questions in chat, okay? Because I can only see the Q&A, so I will be answering from Q&A only. If you want to reach out to us, you can email us at support@amana.app, or you can live chat from our website. You can call us directly. You can send us an email. And if you have a relationship manager, you can reach out to those. I would also like to remind you that we have this weekly iPhone 17 Pro Max lucky draw, which has started and it's happening every week. So what you have to do for that is, if you're a new customer, you have to open an account with Amana app and deposit just $200 and make only a single trade a week, and you would be eligible in that draw. So this draw is happening every week, and you need to be a UAE resident for this. So if you win, you will be notified through email or through a pop-up in the app. So now I'm going to move on to our webinar. So today's webinar is on risk reward ratios and exit strategies. So if you have been attending my webinars earlier, I have covered a lot of things such as risk management, reading the market structures, predicting prices, looking at support and resistance levels, trying to understand price action, trying to understand what is a comprehensive high probability trade setup. So, what this means is that by this time, if you are attending the webinars, you would have a fairly good idea about reading the market, about looking at a certain structure and being able to analyze whether it's a bull market, a bear market, a sideways market, a choppy market, and then being able to identify key support and resistance areas on the higher time frames. As you know, I always advocate trading on the higher time frames because they are clear of all the market noise and intraday fluctuations which might occur in the lower time frames. They also give you a more robust fundamental picture of the macroeconomics or the geopolitical situation, whatever it is. And yes, trends in the long term definitely will play out. They are more strong, more robust as compared to a trend that you found on a smaller time frame, which might just be noise and change. After having said all that, what remains is how to exit a trade. So we have had lots of discussion on what is a good trade entry. Looking at a market, let's suppose, which is trending upwards, we wait for a retracement or a pullback. At that level, we look for a certain bullish price action signal. And after having found this signal, we do our risk management. We determine a specific dollar risk per trade, we put a stop loss, calculate the position size, and enter the trade. Now, after having entered the trade, the question arises, where do you end the trade? How do you exit the trade? Okay. So in today's webinar, I'm going to discuss two very important factors which both relate to this. The first is the risk reward ratios. And the second is again the exits. So a lot of traders will again focus on the perfect entry and they become really good at identifying good entries. But what is more important is how you manage your risk and how effectively you exit. If you have been trading a lot of times, this would have happened to you that you were profitable and then you lost that profit, or you were profitable first but then you ended up with a loss, or you were profitable but you could not like book your profits on time. You let the market snatch the profits away from you, or you had no idea once you were inside where to get outside, or it was a very random exit. It was an exit based on emotions. Maybe you got emotional and you saw the profits come down, so you got afraid and you just closed the trade. So in today's session, we're going to understand how we can plan exits without involving our emotions. And we're also going to discuss the role of stop losses, which is obviously your main line of defense, which are the main feature of your risk management. Without stop losses, there is no concept of risk management and there is no concept of restricting the risk on a trade. Obviously, you can do that if you put a stop loss, right? So again, the risk reward also cannot be calculated on a trade unless you have a stop loss, right? So let's proceed. Before we proceed, please read this disclaimer. So as we discussed, one thing is to identify a good entry. But once you have entered, what is going to determine your survival, what is going to determine your success is how well you have managed your trade and where you actually have planned to exit. Now, not only the risk should be fixed before you enter the trade, but the exit also has to be planned before you've entered the trade. So it's not like you should not have any idea once you're in the trade what you're going to do or where you're going to get out. Okay. So risk reward is basically the ratio between what you are willing to lose on the trade and what you are aiming to earn on the trade. And both of these can only be defined if you have an entry point and if you have a stop loss, right? So the distance, so if you look on the screen, you see this chart, and this chart is describing a short entry. So it's describing a market which you're expecting would fall, hence the stop loss is above your entry, right? So this is a bear market. We're expecting prices to fall, and based on this price action, which is an upward tailed rejector, you put a stop loss above the tail of this rejector, and your entry was at this level. Now, the distance between the stop loss and the entry is the risk. And as I've explained before, you calculate your position size by dividing your fixed risk per trade, which can be anything like 2% of your account's value, by the size of the stop loss, right? So this distance is 1 times your risk or your risk, and the same distance down in this case will make profit for you. And if the market falls, you will profit, right? Because this is a bear market and you have a short position. So the same distance down is going to give you 1 times reward as your risk. Suppose that the dollar risk on this trade is $500, right? Okay, this is just an example. I'm not telling you to take $500 risk per trade. That depends on your equity. It depends on your individual objectives and it depends on your experience level. But this is just an example, and I'm going to use this $500 example for all the trades. So suppose you fixed your risk at the stop loss at $500, right? So whatever is the size of your stop loss, let's say it's gold and the size of your stop loss is $100, right? So if the market goes down by another $100, you will make the same risk, you will make the same reward as your risk. So if the market travels down $100, you will make $500. And if it travels down another $100, you make another $500. And if it goes down another 100 points, you would make another $500. So the risk was 500. And when the market travels the same distance as your stop loss is from your entry, if it travels the same distance in your favor, you make multiples of this reward in this manner. Okay. Now, if you look at every trade like a business, like a small business, like an opportunity where you are committing your capital, right? So the 500 is the cost of that opportunity. Every opportunity has a risk, has a cost. And it just makes sense that if you are risking that much on something, you should actually be aiming to earn at least twice of that, right? So this is one principle that usually traders will aim to make 2 times the reward as the risk. And before that, they would try not to actually exit the trade. Now, there are actually a lot of there can be a lot of arguments with this. Okay, for example, how do we know the market will travel that much in our favor? How do we know the market will not reverse before that, etc. And we will discuss all of that in the course of the webinar, right? But what you need to first understand is the risk reward multiples. Okay, now why is it even important that you need to look at these multiples? Why, not just take anything from the market, right? Why not take $200 or $300, even if you risked $500? What's wrong with that? So, what is actually wrong with this strategy is if you consistently risk more and book less over a series of trades, your account is not going to grow, it's going to shrink. And it doesn't matter how good you are with trading, how good you are with the market's direction, whatever strategy you're using, whatever, right? And this has been proven with many experiments as well. All successful traders look at the risk rewards and they try that the average risk reward of their account should be at least 1 to 2 or more. I'm not saying that you can make that on every trade because trades can sometimes be different, but your average reward that you aim per trade should be twice the risk that you are taking per trade, right? In the previous webinar, I also explained that your per trade risk will be the same across all trades. So for example, if you take 10 trades, in this example, your risk on every trade should be $500. You should not vary that risk because that can lead to other problems, right? Such as slower recovery when you are in losses, right? So you have a dollar risk per trade, not as a percentage. It's usually a fixed amount. And then that should not be varied. It should be kept constant across trades, right? So let's move on. I'm just going to repeat this. This was the way that we calculate our risk. This was calculation of position sizing. We've done it twice before. If you want to understand more detail, you can go to Amana's YouTube channel and you will find all the previous webinars. You can click the webinar which is on risk management to understand this more. I will quickly repeat this. So how do our risk management? How do we calculate the quantity that we want to trade? The first thing is we fix the risk per trade, which can be roughly equal to between 2% and 5% of your account's value. That is the amount you risk per trade. So again, if that amount, let's say, is around $500, this is going to become my risk per trade. I will not change this across trades. The second thing is to select a stop loss level, right? The stop loss level will be based according to the market structure. So again, I'll give you an example. This is the market for the Japanese index, Nikkei 225, which is in a really good trend these days, right? So if I look at this is an uptrend. We are on the daily time frame. So if I look at this particular entry here, the market goes up, it pushes back, gives me a signal to get in, which is this rejector here. How do I put my stop loss, right? So what I'm trying to explain to you is a historical example. We are here right now, but what I'm trying to explain to you, what you would have done if you were here at this moment in time, right? I'm going to zoom this chart in to see you that this was a good high probability entry here. So what I'm going to do is you always put your stop loss below the swing point or below the signal. So I put my stop loss here, right? Below this candle, and perhaps I entered, assuming I entered somewhere near the close of this day. So the close of this day was here. So we are on this day, right? So how do I calculate my position size? Position size is the quantity or the number of shares or contracts I want to trade. I fix my risk first, which is $500. Second thing is I use the formula, which is your quantity is, sorry, if I done, is equal to your risk, your dollar risk divided by the stop loss size. Okay. The stop loss size is given as the distance between your price and the stop loss price. So 61,210 minus 58,929 is your stop loss size. So let me just calculate that. I will assume my risk was, 500. So what I'm going to do is I am doing this. So I'm to calculate the stop loss size here, 61,210 minus 58,929. That's 2,281. That's my stop loss. So then what I do is I do 500 divided by 2,281. It's going to come out to be 0.22. Okay. I will go back to buy. I will change this amount to units and I will write 0.22 here. Okay. And then I will just do buy here. If I want to put the stop loss, I will also put the stop loss here, the stop loss price, which is 58,929. So I will do 58,929. Obviously, this is essential. We have to put the stop loss 58,929. So if the market hits this, were to hit this level, which it didn't, that we found later, we would have been stopped out. So we put the stop loss here and then we just press buy. Okay. And if my stop loss was hit, I would in this case lose exactly $500. Now, the first multiple is going up another 2281 points. So the stop loss size was 2281. So I'm not going to exactly calculate it, but if you add 2281 points to 61,210, that is, okay, let me do this. 61,210 plus 2281. Yeah, so around 63,491. So 63,4, okay, somewhere here. So if the market travels up the same distance, I will make $500, right? And if it travels another of the same distance, so this is an approximation, I make another multiple of my risk and then another. And I basically, if you see, this was a 3-hour trade, which means that it gave you 3 times profit as what you risked. Okay. So this is actually a 3-hour trade. So going back, and this principle can be applied to any market, to gold, to S&P, to oil, to whatever, right? So after we calculate the position size and, we put the stop loss, we enter the trade, the next thing is to understand that we have to aim for more reward than what we initially risked. Now, one thing that we have to understand, and it's very, very interesting, which is that let's say if you make 10 trades and you are 50% wrong and 50% right. So 5 of the trades went wrong and 5 of the trades went right. In case of the risk reward ratio, if being 1-to-1 means you're risking the same and you were aiming for the same, your break even win rate is going to be 50%, which means if you win half and lose half, you would be breaking even. But if your risk reward is 1-to-2, which means you aim for twice the reward as your risk, you will be breaking even at 34. So what you need to do is you need to win only 34% of your trades. The remaining you can just lose. Okay. And still you would have broken even. You would not have lost any money. If your risk reward was 1, 2, 3 on every trade, all you need to do is to get 25% of the times right, and that level would be your break even. So even if 75% of the times you are wrong, your account will still not shrink. Okay. Now I'll give you another better example. Now, if you look at these are different trades. Okay. Now, let's say we have a starting balance of $10,000. You fix your risk at $500 per trade. You are targeting 1 to 2 for every trade. So for every trade, you're targeting $1,000. So either you make $1,000 or you lose $500. It has to be one of these outcomes, right? So in such a case, what this slide is showing you, even if you lose 60% of the trades and you're just right only 40% of the time, your account still grows. Okay. And you can do the calculation yourself. So you've got like 15 trades in front of you. 9 of them are losers, 6 are winners, which means 60% of the time you lost, 40% of the time you won, right? So even then you're growing, you're profiting, your account is growing. So what this means is you don't have to be right all the time. You can be wrong many times, you can be wrong more times than you're right. But this principle of risk reward is so strong, it's so powerful that if you just stick to this, you would still be growing your account. What this means is that for the good trades, don't leave them early. Okay, if you are in a good trade, if you are in a good setup, you need to keep the trade running so that you can profit from it and you can make more multiples of your risk. So in the calculation, you would have won $4,000 and you would have lost 3,000, but the net profit is again, you have made a 10% return here. So now we're going to go to the next topic here, which is the exit, right? So again, the exit is a very tricky part of the strategy because as compared to the entries. So the entries, like we discussed before, have a certain predefined setup. You're looking for a certain level, a certain price action signal. And when you're out of the trade, you are calm and you're not emotional, right? But once you are in, and that is when you're making your entry decisions. Once you are in the trade, your objectivity might be influenced because the emotions come in. Every tick against you sometimes spook you, can make you feel nervous. Every tick which is in your favor feels good. It feels like you are making money. So the emotions get involved. So the exits have to then be planned earlier. Okay. And that is very important because once you're in the trade, you might just get lost in the flow, in the ebb and flow of the market, especially if you're new, especially if you have not built that kind of mental discipline, right? So there can be two exits. Either you get stopped out when your stop loss gets hit, or the trade goes in your favor and you have a successful outcome. So there can be a negative exit when you get stopped out, and a positive exit when your trade goes towards your profit target. So again, how do we plan the trade? Okay. Once you define a stop loss and you calculate the position size and you get in the market, the first thing that you should always remember is when you put a stop loss, you cannot change the stop loss, please. You can only change the stop loss if the market moves in your favor, right? For example, if you look at this chart in front of you, this is a bullish market, okay? And this is where the stop loss is, and this line represents your entry, this line represents your stop loss. Now, you have calculated your position size according to the stop loss because that's, you divide the dollar by the stop loss size. So the stop loss has gone in the calculation. Now, what you cannot do is push this down. If you push this down, you are increasing your risk on the trade. And that will mess everything up. It will mess your risk management. It will mess your risk reward multiples. So what we can do is we can push this upwards later. And I will explain to you how. First of all, what I like to do is I like to select markets which are trending, heavily trending markets. So if I have 3 or 4 markets in front of me, I gave you the example of indices. I love the indices because the indices are like, they trend very well, right? And they can give you good risk reward ratios. There could be markets which are more choppy or, which are sideways where you might not be able to make that good multiples of risk. So you might not be able to get good risk reward, right? So choose those markets which are trending very heavily, which have fast trends to get the best results. So we have other markets as well, but if you are not sure about what's happening, about what is the overall trend, about what is the overall direction, then I suggest, don't trade those markets. Only go for the most high probability markets. So what we do is, once we enter and the trade moves in our favor, we can actually do a positive stop loss trail, which means pushing your stop loss. So this was my stop loss. So what I do is, when I end up being here, I push my stop loss to the break even point, like that. So what I'm going to do is, I'm actually going to go and I'm going to be modifying my trade just to tell you how it's done. So let's say, this is just a random value. I'm just giving you an example of how do you modify the stop loss. Okay. So I'm in the trade, and then what I do is, to change the stop loss, I will go to positions. Here, I will go to click here. I will do modify, and then I will change my stop loss here. And I will change it to the break even price, the price at which I entered the trade. So I can change the stop loss at any time I want, right? So, okay, let's go back to this, right? So what I did was, I pushed my stop loss to break even. What does that mean? That means I've removed any risk on my trade. Now my trade is riskless. It's, even if my stop loss is hit, it's at the break even point and I don't end up losing any money. So that's essentially a risk-free trade now, right? If it moves in my favor, it moves. And if it doesn't, then I just get out nothing with no loss. And the second question now is, how soon can we do that? How soon can we push the stop loss to break even? Now, you have to be careful with it, because, let me close this, because there are too many lines. They can be confusing. So I will, yeah. So when should I push my stop loss to break even? This was the stop loss, this was the entry. Ideally, what I would do is, I would wait for at least one multiple or one times reward as my risk before I push my stop loss, right? It also depends on how big is my stop loss size. If I have a small stop loss, then it could be risky, even or with one time or with 1 hour, for me to push it to break even. Because what happens sometimes is, I can actually get stopped out because of some minor fluctuation or market noise. So a bit of discretion is involved. But in this case, I see that the stop loss sizes are pretty, it's a big stop loss. In this case, I can move my stop loss to break even when I'm at the first multiple, when I'm at 1 hour, right? Or if you feel it's too early, then you can wait for 1.2 or 1.5 hour and move it. Some people prefer to move the stop loss at 2 hour. So if you get twice the reward as your risk, that's when they will put the stop loss to break even. That's when they want to stay in the trade. They don't want to close the trade. They want to keep the trade running because they are expecting that prices will keep moving in their favor. Now, that doesn't always happen. It only happens in fast trending markets, like the indices have been trending quite fast in the previous few months. So if I just go for other markets like S&P again, okay, this trend of S&P here, all this rally, this was a pretty fast trend, and it could have been traded with you staying in the trade and you just pushing your stop loss up. So again, if you make 3 times multiple, then you can actually, so if you are here, then you can actually push your stop loss from here to here. And again, you will be locking in 2 hour profit. And if you want to keep the trade running, you can keep the trade running. It depends on the state of the market. You don't always have to keep it running. You can also book the profit at 2 hour or 3 hour, and that depends. Now, what does it depend on? That's the question. Now, it depends on 3 things. How do I exit? Basically depends on 3 things. The first thing is, I need to check how much reward I have made compared to my risk. What's the reward multiple? If it is 2 or close to 2, I should then be happy, and I should be looking at other reasons why I should stay in the market or why I should get out. So one thing is, look at your risk reward multiple. Now, it doesn't have to be exactly 2. It could be like 1.7, 1.8, or 2.2, or close to 2 times. But again, you get the idea that we are aiming to earn more than what we have risked over a series of trades. Okay. So that we can get the maximum benefit out of the winning trades, out of the, fast moves in the market. We don't want to miss that profit. The second thing that I'll be looking for is there any price action signal which is now forming, which is counter to my trade. So let's say we have a fast moving market, and I will go back to S&P and we look at the rally here, right? So I have this whole rally. So this, if somebody was actually trading it here, this engulfer with this red candle is a sign of profit taking. So looking at this sign, I could just close my trade. That I have a reason which is given to me by the market. That reason is bearishness setting in the market. I am not going to close the trade because I feel like closing the trade. I'm going to close the trade because I see, okay, I have made sufficient I'm satisfied with the reward multiple. And yes, the market is now giving me a proper signal that it could move against me. This is not based on a feeling, it's based on a signal from the chart, right? So again, if you keep trailing your stop losses, the worst can be, you lose a bit of profit, but you don't lose all your profit. Now, the market has actually, if you see what happened on Friday, that we had a very big bearish streak on Friday after all this bullish run in all of the indices, and about $2 trillion were wiped from the market. And you could see this candle, right? So what this calls for is to wait and to see how the market is going to perform, especially for this week, and how this week is going to end, right? The market could actually correct. It could come down to previous levels. We don't know. We have to keep watching the market. We have to keep looking at the price action. And it's basically the price action which gives us the biggest clues about where a dip is ending and where you can re-enter a market, which is long-term bullish. And yes, there can be traders who might want to short the market based on this signal. So we have a really strong bearish rejector. So some people also do counter trend trading. So in this case, there is a reason. There's a very big bullish, very clear bearish signal here, which is signifying that market can go down. So that's not wrong. It just depends on your strategy. I am like a long-term trend follower, so I will not short the indices. But if you short them, that's not wrong because your reason is coming from the chart. It's coming from the market itself. It's not coming because you just felt that the market is going down. It has already given you a clear signal, right? So, but then again, counter trend trading does not always give you the best risk reward multiples because the counter trend moves, in this case, the downward moves are going to be smaller than the upward moves. That's usually the case with trends. So in an uptrend, upward moves are going to be much bigger than the downward moves. In a downtrend, the downward moves are going to be much bigger than the upward moves. Yes. So I was explaining to you the reasons why, where, and when you should exit. So the first is looking at your risk reward multiple and getting satisfied from that. Should be ideally close to 2, or it can be more. That's even better. The second is looking at any opposite, any signal, any opposite price action, and that can make you close your trade. The third can be prices approaching a resistance. Suppose that you are a buyer, prices are going up, yet they're approaching a certain resistance point, which is a historical resistance. That can also cause you to close, especially if you find an opposing price action signal at the resistance. So these are some of the reasons that can actually cause you to close your trade. Another question which may have come into your mind is, what happens if you just started into a trade and the market started to give you opposite signals? So you haven't made even, one multiple of your risk, 1 hour, or you haven't reached 2 hour, and the market has shown clear signs that it will move against you. So this can be an exception. It should not usually happen if your entry is correct. If you've entered at a retracement or in a downtrend, if you've entered at a pullback, it shouldn't usually happen, but it can happen once in a while. And if it does happen, then it's okay to close the trade, even if you have made very little profit, even if you haven't made 1 hour. But that has to be based on a chart based reason. It should not be based on your emotions. So if you start a trade and then you just keep staring at the screen all the time and you see every tick and you're confused and you get emotional and you just close the trade because you think the market was coming down, that is completely wrong. Okay. What is right is let the market, especially the higher time frame, the daily time frame, give you a signal, a price action signal, which is contrary to your trade. That gives you good reason to close your trade. Okay. So if I look at this market, this is the market for, let me go to Brent. So this is the oil. This is Brent crude. This is the UK oil. Now this market, I'm on the daily time frame, and this market is a range bound market. So it is maintaining a certain range, right? So this is approximately the lower bound, and this is approximately the upper bound. So the upper and the lower bounds are approximate price zones. It's not a single level, it's an entire price zone. So it's roughly trading between 88 and 112. And how I've drawn these lines is just from experience. What I've done is I'm drawing an average line of fit. And what this market is showing me, this market is a range bound market, which means it hits an upper bound, it comes down, hits a lower bound, and then it comes down and hits an upper bound. The best way to trade this is at the lower bound, we look for positive bullish price action signals to enter, and at the upper bound, we look for bearish price action signals to enter, right? So we don't enter blindly even at the price levels. We wait and look for candles to form which will support that level. Okay. In this case, you could still get a good risk reward. So this is an example of a market where your exit consideration has the support level included in it as well. What that means is if I'm buying here around these levels, I know the exit has to be around, should be around these levels because the market, there's a resistance up there. So a resistance and can also, or a support can also be consideration in where you will exit, apart from the price action and apart from the risk reward multiple, right? So as an example, again, if I look at this entire move, if I just assume, now I have to assume that, prices are going to move up again, right? So this is again an assumption. I don't have a clear price action signal which is supporting this, but I'm doing this just for the sake of making you understand how we look at risk reward multiples. It's not an actual entry because to buy right now, I need a proper bullish signal at this price. If I do get a bullish signal, and it's a good entry point. But right now, there is no bullish signal, right? There's no satisfactory bullishness at this level that would, make me think that, yes, the support is strong, the support will hold, right? But if I just look at this candle, this has a lower wick, and lower wick candles are very good at pushing prices up. So if, let's say, somebody had taken a trade based on this, the stop loss will always go below the wick. So this is your, risk. And then we look at the reward multiples as being the same distance up, right? So this was 1 times reward on this trade, and then this was the second time. So I'm just looking at the potential of this trade or this move in terms of the risk reward. Third, and almost 3.6, 3.7, right? So what this means is that, you enter here with a $500 risk, you make 500, another 500, another 500, and almost another 500. So you could have made about $2,000 with a $500 risk because the reward multiple is good. So again, how would you have known where to exit? This is an indecision candle after a big bullish move. This is pretty much a signal the bullishness has faded. So I look at this candle. Second thing again is I am at a resistance zone. So both of these factors. I am at a resistance zone. I have an indecision candle right after a bullish move. It means bullishness is fading. So I could have exited around these levels. So again, I am looking for proper reason to close the trade, right? How I would have done, what I would have done here is when I reach here or a little bit up, I will have pushed my stop loss to break even. And when I reach here, I could have pushed my stop loss higher, but please don't do it consistently or don't do very small moves. You have to give the trade some room to breathe. So if you just keep the stop loss very close as well, you can get stopped out. So there should still be a distance that, as the original distance between your stop and entry, keep that same distance so that there's room for the trade to fluctuate and breathe, which is part of the markets, because markets never go up in a straight line, they're always fluctuating. So now this is again a comparison between how we can, what is your urge and what is the fix. So the urge is no plan, just jumping into the market, just with the intention of making profit. You did not calculate your risk, you didn't calculate your position size, you don't know where you're going to stop or how you're going to stop. The fix is you write your exact stop, target, you calculate the position size according to your fixed dollar risk on the trade, exactly where you will make 1 hour and 2 hour and so on. Okay. Other thing is over leveraging, which means taking big position sizes, which are going to involve a lot of your emotions into the trade. Again, this is simply fixed by managing your risk. So if you don't manage your risk, you can only over leverage if you haven't done your position sizing. That's the only way, right? If you haven't put a stop loss. If you do that, then actually the trade is open in terms of not of being prone to any amount of loss. So if you haven't defined your loss before you entered, you are going to be very nervous during the trade and you're going to be very emotional and you will be reacting more. You will be watching the market all the time. You would not be able to leave the trade alone because there's a big position size. You don't know how much you can lose. You haven't planned the trade. If you plan the trade with a stop loss and with a fixed risk, it becomes easy to just walk away from it and let the market do the job. Another thing that can affect your trading is recency bias, means that you lost a lot of money before, and now when you're taking the next trade, you are very fearful, and that fear will make you lose more. So you will do things that you're not supposed to do. You have to remember that you cannot judge yourself from one trade. You have to execute the risk management and everything else over a series of trades, at least I would say 10 trades, and keep a trading journal. In the trading journal, you have to write what was your risk per trade, which should be the same across trades. You have to write the reason for entries, which should be 3 or 4 reasons, which I've explained before. You have to write what's your profit target, right? So if you maintain such a journal over time, you can understand what's your weakness. What is it that you are prone to overlooking? Is the risk management your weakness? Is and entering poorly and not waiting for a price action signal? What is your weakness? And that really helps. One thing more is screen watching. Please don't do that. Once you have, like started a trade and fixed the trade with the stop loss and everything, you should not ideally be looking at that trade again and again. Just, maybe check it after every 8 hours or 10 hours, just once. Because if you keep checking it, then you are bound to interfere for no reason. Now, one interesting thing is that you must have heard that when people trade on a demo account, they're very good and the kind of success that they have is amazing. So I know so many people who would say, I earned 10 times on my demo account. I, made 10x out of that. So I just put $10,000. I ended up with 100,000. And it's very common. And what is the reason? The reason is that you are not anxious there because it's not real money. Your emotions are not involved, right? So you don't get triggered and you don't interfere. And when you don't interfere, you exactly follow your price prediction. And when you do, you end up making all that money, right? So the only difference between a demo and a live is the emotions which get involved. And it is the emotions which are actually the biggest challenge in trading. And how can we keep them at bay? When we fix our risk. When you fix your risk, it's going to make a huge impact on your emotional behavior, on your psychology, on your discipline. It will become much more easy to, follow your trading plan. So this is the set and forget principle. What does it say? It says that after you enter a trade with all the conditions, with the risk management in place, with the stop loss in place, with the right quantity, with the right conditions, after that, you should not do anything. You have to forget about the trade, right? So Your default state after entering a trade is not doing anything. That's the best thing. It's progressing, it's going up. Don't do anything. Don't check it. Don't go back and check it again and again. Because the more you check, the more prone you are to interfering, right? Again, if you see the price is dropping towards your stop loss, what do? You don't do anything. Your stop loss is not yet hit. You've placed your loss at an invalidation point below a swing that is not easily broken. Okay. And in case it's broken and you know that your thesis was wrong or your way of thinking or your setup has failed. So you don't do anything as long as your stop loss is not hit. You don't push your stop loss down. You don't change your stop loss because obviously that changes your risk. So if you feel nervous, you don't do anything. This is something that, experience will teach you. So, and yes, absolutely, the live does teach you more than demo, and it teaches you a lot in terms of how to manage your emotions. So, if you're just starting off, you can just have a small amount of money. Start with a small amount that you're comfortable losing, but make the trades and follow these principles. Put a stop loss on every trade. Just test yourself, and you will see every time that you risk more, your emotions will be involved and you will be anxious and you will be always reacting in a wrong way. You will not, it will be very difficult to keep yourself calm because you haven't done the right thing. When you do the right thing, you will feel very calm. You will not feel that need to check the trade again and again. So if you have to do any intervention, it has to be a chart based reason. It doesn't have to be based on your emotions. It has to be something which is clearly coming from the chart. Like I said, a price action signal which is against your trade. So there is another interesting concept in a good trending market, and that is that not only do you trail your stop loss favorably, you can also add to your position. So what does that mean? That means that in a fast trending market, you entered here, price moves up, you push your stop loss to break even. Now you can actually open another trade because on the first trade you have no risk, right? So your risk is zero because your stop loss is at break even. You can actually open another trade, but that trade is going to have its own stop loss depending on the conditions of the market, and it's going to have a risk on it, right? A fixed risk. So now instead of one trade having $500 risk, you have one trade which has no risk, and the second one has the new risk, 500 of risk, right? So the advantage of that is that you are scaling in, you're adding to your position in a very fast trending market, but you're not doing it blindly. You have removed the risk on the first trade, and then you are opening a new trade or you're adding to your position. And yes, then, if the market keeps going in your favor, you can do that to the second trade as well. You can move the stop loss for the second trade. But again, this is reserved for very, very clearly trending and fast moving markets. It might not work well in all markets. So this is just a checklist before you enter a trade. Check all of these things. Did I have a written exit plan before entering, or even in your mind, do you have a certain target? Did I exit based on my plan or based on emotion? So all this analysis should be done after the trade, post the trade. If there was a loss, was it because your stop loss was hit, or because you just closed the trade for no reason, or you got anxious? If it was a win, what was your reward multiple? Was it around 2 times or more than two? Was it less than that? Did you close the trade quickly because you got frightened, or did you let the trade run to a proper risk reward level? Did you actually push your stop loss, in an unfavorable way? So favorable base, again, the stop loss trail that I was talking about, but the unfavorable is when, as a buyer, you actually push it down, which increases your risk. So check if you did that or if you let the stop loss stay where it was. And then did you watch the screen excessively? So how much did you watch the screen in 12 hours? How many times? Was it like, what was the time that you spent in front of the screen? So in 12 hours, if you are spending more than 2 hours or 3 hours, that is a lot. Definitely, this depends on your strategy too. On the higher time frames, you don't have to spend much time. You can actually be spending 15 minutes or something, 20 minutes, 30 minutes in a day, because the higher time frames do not change during the day. They will only change every day or every week if you're on the weekly time frame. But if you are an intraday trader, then yes, you will get more signals during the day. So you will have to watch more. But even as an intraday trader, even if you are on the 4 hour chart, where you get a signal every 4 hours, the only thing that you should be doing is observing the next candle, which is just looking at the completed candle, which happens after 4 hours. So the more that you watch the screen, the worse it is for you because it leads to more interference. So it should be a set and forget strategy. And again, we've discussed all this. You need to calculate your risk and you need to size yourself based on the calculation I told you. Target at least 2 times reward as your risk, or try to do that as much as possible, as far as possible. Never trail your stop loss in an unfavorable way. You can trail it in a favorable way. Okay. Judge your performance over a minimum of 20 trades. Yeah. So especially if you're a beginner and if you are trading every day or and so on, your performance should not be judged over 2 or 3 trades. You need to have a series of trades. You need to actually journal your behavior, and that is going to help you understand what you're doing wrong and what are your weaknesses and how you can improve. So this is it for today, and I hope that you've enjoyed this webinar, and we will meet next week, next Tuesday at the same time. Thank you.